Welcome, everybody. I'm Mark Peter Davis, Managing Partner of Interplay. I'm on a mission to help entrepreneurs advance society, and this podcast is part of that effort. Today, we have our standard partner meeting, but it has been a bizarre week. As everyone knows, we've had 3 banks collapse in the last 7, 8, 9 days. Silvergate, SVB, and Signature Bank. A lot of political decisions were made. Things happened. The Interplay team has been working around the clock to support entrepreneurs through the service companies, lots of clients trying to figure out how to navigate this, portfolio companies figuring out financing solutions. Thankfully, it seems like all of the major immediate impacts have been unraveled with guaranteed liquidity. But there is still a lot to come on this. There's a lot of implications, both short and long term. So we have a little bit of an interesting segment today. We actually recorded Chris's segment on the broader market hours before SVB actually closed shop. And since so much has changed since then, we recorded a second segment. And we thought the first segment was pretty good. And so we actually are putting the segments back to back. So you can hear kind of a before and after. And I think they line up pretty nicely and share really relevant insight. Will help you understand what's happening, why it's happening, and what it means. Enjoy.
Yeah, so first of all, this is the elephant in the room. We're going to talk about it. I'm itching to talk about it. But before that, I want to cover 2 macro topics first that are also important this week. But the headline to your question, just so that I don't leave it hanging, is Silvergate is definitely much more benign situation. The way management handled communication, the way they actually panned out, how it's winding down its operations, guaranteeing its deposit base to be paid back. It's okay. This happened. It's okay. So SVB, on the other hand, is a totally different situation, and it's looking like it's going into the gutters. So we'll talk about that, and they're very different situations. All right. So let's talk about macro first. 2 very important things happened this week. First one is Fed comments. So tied to inflation, tied to interest rate curve. We've been talking about this for months, but importantly, Chairman Powell came out on Tuesday, March 6th, I believe, spoke to the Senate Banking Committee, and it's safe to say that the one-liner summary is that he was a lot more hawkish than expected during the speech, and he was very, very clear as well. And I quote him: "Latest economic data has come out stronger than expected, which suggests that the ultimate level of interest rates is likely to be higher than previously anticipated." Okay, so this is something we've been talking about. We expected this to happen. Market apparently did not. Immediate aftermath, repriced the entire interest rate curve. Now going into March 21, 2022, FOMC, market is now pricing in a 50 basis point hike as opposed to 25. That will bring us to a 5% hurdle for front-end interest rate. The entire front end part of the treasury curve has also been repriced. We're talking about a 15, 20 basis point increase intra-week. And the peak interest rate now has been priced in by the market is at 5.3 by August this year, but still, for some reason, pricing a cut by the end of the year. So we're getting closer. The broader highlight is we're getting closer and closer to what internally we expect, which is a 5.5, 6% range of peak interest rates and staying there for longer. And so we're getting closer to that, which is a good thing. Equity, of course, has responded to this. Intra-week we sold off a lot, even before the whole SVB situation. So all this I see is healthy, and we're getting closer to what we expect.
Okay.
That's point number 1. Point number 2, jobs. So just came out today, the non-farm payroll data for February 2023. This is the data that everyone's been waiting for. Again, the headline is very strong. We added 311,000 jobs, which is beating the 225,000 jobs consensus. Interestingly, unemployment actually ticked up by 20 basis points. So we're finally off the 54-year low. We're at 3.6%. Largely, this is because in February, we added 419,000 jobs total into the labor force. So labor force participation has now finally basically come back to pre-pandemic levels. And a lot of that is led by, as we can expect, leisure and hospitality, and retail, a little bit of government jobs and healthcare. Transportation was a sector that suffered, but broadly speaking, labor market very strong. One counter argument to that is the average hourly earning. So that came as part of the report. Average hourly earning grew by a slower than anticipated amount. On the surface, it's actually good news for inflation. It means people, as the wage goes down, aggregate demand should go down, thereby slowing down inflation. But we don't really know whether this sort of slower than expected increase is due to the type of jobs that were added, meaning less management, more entry-level jobs, or is it because everybody's wage is actually slowing down, right? The wage growth slowing down. In the case of the first, it doesn't do too much inflation. In the case of the second, it does. So we don't know whether this is a good thing or bad thing for inflation, but at least it's trending in the right direction. That's it for the macro segment.
So the wave is still moving through the economy. Things are still going. Let's talk about the banks, because that's the current. I gotta know what's going on.
Yeah. So, man, it's been a bloodbath week for the financial sector this week. Let's just say, before we delve into SVB, on an aggregate level, the S&P financial sector, which traditionally has been a very defensive sector, was down 8.3% week to date for the week ending on March 10th, which is the worst week since the major sell-off we experienced in 2020. Okay, that's the headline. Silvergate, I think you've talked about with Brad. As I mentioned, they lost a lot of money in sort of treasuries, right? And of course, investor withdrawing deposits, et cetera, which that's what led them to sell the assets at a less than ideal time. They're winding down operations, just go relatively smoothly. There's no hiccup so far. So that's okay. Silicon Valley Bank, frankly, the way I'm seeing it now, as people still digest the news, they basically shot themselves in the foot. They were obviously aware of what's happening with Silvergate, but for whatever reason, they've decided to come out and raise over $2 billion in equity financing in the same week where people were worried about Silvergate and the whole deposit base. In their own words, to shore up their capital stack, to shore up their liquidity situation. People are obviously worried about this, so that basically pushed all the investors to get a closer look at their balance sheet, see what happened. They effectively had to sell $21 billion worth of government bonds at a $1.8 billion loss, right? And so that's number one. So mismanaged balance sheet on their end. Secondly, you know this, Mark, this SVB does not have a well-diversified deposit base. It's mostly servicing VCs, entrepreneurs, founders. We all knew what happened last year in the tech world. More cash burn, less valuation growth, less money coming in, less money being raised, which means less deposit base, more forced withdrawal, which leads to more forced selling at a loss. So this is a classic bank run situation right now, what we have going. The equity of the stock sold off, I think more than 60% yesterday during the day, and in the aftermarket sold off by another 25%. Wow. Today, this morning, it opened up another 40 to 60% down, which halted the market trading. So this is effectively like a Lehman for VCs and entrepreneurs. We've heard internally, a lot of VCs are also advising their portfolio companies to withdraw cash if they have any exposure. Union Square Ventures, a few other funds have come out publicly, sort of giving advice to their portfolio companies, and so the bank run situation has been compounded. At this point, we don't know what's going to happen because we don't know the numbers. It's not public. We only have sort of their February numbers and don't have anything current. But my sense is that they are getting closer, if not already, in the sort of insolvent situation where the capital flight is much greater than what they actually have as liquid as part of their balance sheet. So what's going to happen? Well, we need a white knight. They need a white knight. They need a consortium of probably private equity firms. I don't think any bank will come in here and help them out. And so they need a consortium of private equity firms to come in and rescue them, potentially buy out the assets. And so far, that's not been the case. They tried this morning, tried overnight. Nothing. There are rumors flying all around. There's no concrete plan as of yet. And they need this capital fast. Every minute matters. There's more deposit being withdrawn every minute. And when they get to a point where this is truly insolvent, that will be too late. So let's see what happens.
So was SVB actually in financial trouble, like real financial trouble, when they started all of this? Because the major story is people got nervous in the context of what was going on in the market, the Silvergate. Everyone was nervous. They got a little bit of bad news from SVB, and there was a run on the bank, and everyone took their money out, and that actually killed SVB. Okay. Were they actually in real financial trouble before everyone started pulling their money out?
They were not insolvent. That's for sure. Just looking at their 10K from February this year, they were not insolvent. They had they're not well capitalized, but they were not insolvent. They incurred a massive loss in their forced selling of government bonds and mortgage-backed securities. And so I understand, these are fixed rate instruments, right? So as interest rate rose unexpectedly last year, they took a mark-to-market loss on these instruments, but they didn't realize them until they had to be basically forced sold, which is what panned out afterwards. So they're not insolvent, but they're not well capitalized. And more importantly, is their deposit base incredibly concentrated. And that's the point I want to really drive through here, is because naturally the question you will ask is this going to be systemic? Is this going to affect all banks, like what the S&P financial sector has been experiencing this week? My inclination is no, this should not be systemic. So in that case, it's not so similar to Lehman, because most of the banks out, the big ones, are very well capitalized now versus 2008, and they have a very diversified deposit base. So any particular sector downturn won't affect them as much. But for banks that are, let's say, regionally located, have a very concentrated deposit base, and is not well capitalized, and there are a few names out there that you can probably think about, similar profile to SVB, that will be systemic. They will be in trouble.
So it feels like the narrative lately, obviously, has been tech companies in trouble. We're the industry that's getting hit hardest by the overarching shift. Is this are we the bellwether, the canary in the coal mine of like, hey, a tidal wave's coming, we've hit the tech industry, and now it's going to bleed through? Or is most of the story about this economic cycle going to be the tech industry, and then it kind of filters out a little bit to everybody else, but not as big?
So far, I think it's still very much contained in tech in general. A lot of it obviously is the valuation. It was the bubble that was created in 2020, 2021. So far, we haven't seen a really widespread implication to other sectors. And in fact, there are sectors that are booming more so than people expect, like energy and hospitality. So it's so far is limited impact. Where are we in that cycle within tech? That's the $1 trillion question. We don't know, because every week seems like there's more and more implications that are coming out. For instance, SVB. And we don't even know how SVB is going to play out, because if they ultimately have to go through Chapter 7, hopefully not, and how will that translate to the cash burns, the loans, the operating loans that all these startups dependent on, GP commits, it's going to be systemic within tech if they have to go through Chapter 7 and everyone has to take a markdown. So let's see. I mean, we'll see how this plays out in the next week or two.
Wild times. Thank you, Chris.
Of course. Pleasure.
So, Chris, it's been a hell of a week in startup land. We've never done this before, but the last segment we recorded before this fall of SVB, We're now recording a couple days after the fall. We just felt like I feel like we have to add something to kind of get people color on what's going on. And too much has changed in a few days. So what's catch us up? What's the latest?
Yeah, Mark, I think the impact is not just in startup land. I think this has been probably one of the most excruciating weekend, really in everybody's mind, in recent memory. Friday, we absolutely ended on the worst note possible. There was maximum uncertainty and minimum resolution. Market absolutely hated it. We're in the gutters by the close on Friday, I believe March 10th. And over the weekend, it was just zero news up until right around 6 p.m. Sunday night. Right on schedule, there was a joint statement that came out from the Fed, FDIC, and the Treasury in what I consider an unprecedented move. Effectively, everyone involved in the government came together and published a joint statement and effectively guaranteeing the deposits from SVB and Signature Bank. Signature Bank also closed over the weekend, and this is more to do with Silvergate and crypto than SVB, than startup in general. But it shows you the contagion at that point has spread so significantly that it's causing all these second order, third order impacts. In addition to the guaranteeing of deposits, the Fed also launched what's called a bank term funding program, BTFP, offering loans to all, effectively up to 1 year maturity, to effectively all depository institutions in the US who can pledge treasuries, agency debt, mortgage-backed securities as collateral, which is basically what all of them hold anyways on their assets. And this, at least temporarily, has stopped the bank run from Friday. But it did not, in any shape or form, stop the volatility on Monday. On Monday, and this is where the sort of the post-mortem of this whole situation started to really pan out. Basically, I don't even know. Every market was volatile. It's not just equities in the regional banks, which is what everyone's been talking about in probably media. It's everything. It's interest rates, it's equity, it's global equity, it's currency. Every single market was going through incredible volatility, like what we've seen in the likes of March 2020 and the financial crisis. Just a few highlights in those markets, just so that people can have a sense of magnitude. Let's start with Treasury curve. The 2-year Treasury curve rallied 100 basis points on Friday and Monday. And ultimately, on Tuesday, March 14th today, which we're recording, recovered 20 basis points. 100 basis point move in a 2-year and a 50 basis point move in a 10-year Treasury. This is the equivalent to effectively a 25-30 volatility adjusted, about 25 to 30% move in an equity market. Wow. Incredible amount of volatility. And what does that mean from an FOMC perspective, the Fed meeting that we're going to have next week? Effectively, the market, right before Friday, before the collapse of SVB, the market was pricing in a 25 to 50 basis point hike. On Monday, given the rates move, now the market is pricing in a 0% move. And not only that, a 100 basis point cut by the end of the year. So this has completely changed the picture. We've talked about this internally. They're obviously on paper dual mandate from the Fed: inflation and employment. But there's a third mandate. And this third mandate, even though it's not mandated by law, it's arguably the most important, the one that takes priority when it surfaces, which is market stability. So I guess what I'm trying to say is I personally haven't been in the market in the past. I don't see this move as very unpredictable and unprecedented. I think that the way the interest rate markets are pricing these moves how we are shifting from a hiking cycle immediately to a cutting cycle makes sense, because this is the number one priority. The Fed needs to come out and accommodate the market instead of tightening the market, and just reintroduce stability. And after that, we can talk about inflation. We can talk about employment. Nothing else matters as much. And that's just the interest rate market. I mean, what we're seeing is a complete reversal also in the equity market. This is where things are probably the most volatile, and that's received the most amount of coverage. The regional banks, everything from sort of second in command FRB to the smaller regional banks people never heard of, as long as they're publicly traded, we're seeing shares moving in 20, 30, 40, 60% intraday, up and down. It makes sense, again, because SVB, yes, deposits were insured, but equity was entirely wiped out. Loans and bonds are absolutely impaired. We're talking about, the bids in the market are showing 20, 30 cents on the dollar. So it's a good news deposits are insured, but absolutely horrible news for any equity holder of any banks. Of course, there's always a winner from all of this, and that's the bulge bracket. JP Morgan, Goldman Sachs, Wells Fargo, Bank of America, the big bulge bracket banks have all gained significant amount of deposits overnight, and the shares are trading accordingly. I went to dinner
There's
March.
other winners in this too. I think the macro winners are the big banks. And I've had some of those conversations too. The neobanks are also crushing it. Right. We're investors in a company called Row.co, and they have a modern interface for a bank. They've got a product which allows companies to hold up to $75 million of capital in one account with FDIC coverage, because it's like a meta bank. On the back end, they're spreading that capital across 400 accounts. We're seeing all of the neobanks explode with deposits as people are looking for different types of products and solutions in the market right now.
Yeah, absolutely. There's tech solution out there, like you mentioned, that effectively spreads your deposit base automatically for you across 50 different institutions under the FDIC insurance limit. It's a smart move. Frankly, depositors should never have a risk to begin with, but the aftermath is such that we're now in a world where we need to worry about it. And why spend all the effort opening up all the new bank accounts across this institutions, reestablish relationships, when you can just do it with one account? I would sort of caution against counterparty risk. Just make sure you're not taking on additional counterparty risk by doing this. But I agree with you. It's generally a good idea. So maybe let's talk about impacts. Short-term, medium-term, long-term impact. And this is just my view. I did go to a dinner last night with a bunch of other CIOs of different institutional level family offices where we sat down and talked about this. I think we all agree at the end that in the short term, we're definitely going to see continued volatility in regional banks. And this will largely accelerate the tightening of what is currently, where we are currently in the credit cycle. We're sort of already in the tightening cycle, but now this move just accelerated that. In the medium term, this is where I think things really get interesting. I personally think, given where rates are and where rates will be, at least according to the market, there's going to be an accelerated weakening of the dollar, as we sort of first talked about at the beginning of the year. And on the back of that, and of course, as lower rates as well, I personally think we're going to see a reversal and, in fact, a broad-based stock rally in equities in the medium term once the initial wave of fear and all the messes get sorted out.
Right.
But there will be winners and losers, of course. When I say broad-based, I don't mean literally everybody. I mean most sectors, but especially the big tech, which were really hit in 2021 and 2022 when the Fed began to really hike. and also in sectors that are already winners and will become even bigger winners, like energy, on the back of a weaker dollar, and travel and hospitality. So there will be winners for sure, but the regional banks will continue to be volatile. Before I even move on to long term, I want to highlight one more thing, which is I think it needs to be addressed that the regional banks serve a very important role in the lending and financial health of the U.S. The last thing you want is the bulge bracket banks taking all the businesses and making the entire lending market in the U.S. not competitive. So if you're a business, you want to borrow a loan, you want these smaller players to come in and offer you competitive rates. That accelerates your business growth and drives down your cost of capital. You do not want to only deal with trillion-dollar banks that couldn't care about you and give you the most horrible rates. So there's definitely a role here, and I really, really hope that vast majority of these sort of middle market and regional banks survive this fiasco. And that requires a lot of leadership, I think, from the government. The longer term impact, and this is the part I think we've talked about also previously in the pod, I think this is ultimately really bad for the dollar as the reserve currency. This destroys confidence and certainly makes you question the trust. Like if you're an international investor, you followed what happened over the weekend. You have to think about diversifying away from the dollar. You just don't know what will happen if this bank run doesn't stop. You just hate to think about what could have happened and what that would do to what's already a very challenging balance sheet in the U.S. government. If you add another $1 trillion to our debt, what would happen to the dollar? So it's something I think no one's talking about, but I think this is the most fundamental impact out of this entire narrative.
I mean, this is the Ray Dalio thesis.
Yeah.
That we're on a collision course with losing reserve currency status, which I don't know if people understand, but right now we basically can lend money to ourselves in any other country because everyone wants to hold dollars. If they stop wanting to hold dollars, we basically have to live within our means, which is what every other country more or less does. They largely spend what they earn, they borrow, but we are able to do it at insane levels because we are the bank. Yep. And England was the bank before us until the 60s. They were the reserve currency. And there's no reason to believe we will be the bank forever if we have a huge debt problem in the country.
Yeah, 100%. So let's see what will happen. We're at the early innings of this. There's by no means the show has stopped. Everyone needs to continue to be alert and monitor the situation. Yeah, let's see.
Thank you, Chris. A quick reminder for everybody: Chris is an SEC registered RIA, and nothing he said should be considered investment advice.
Thanks, Mark.
What's up, Brett?
What's going on, Mark? Yeah, this week has been a little bit hectic from a banking perspective.
Yeah, but it feels like one week after another, walls are falling down. You know, there's a ripple effect still happening.
Yeah, for people that don't know, Silvergate, one of the early banks to actually embrace crypto and go all in on it, is going to be closing its doors. They let us know that a couple days ago. They lost about $1 billion last quarter, and customers withdrew. I think it was like $10 billion. So it's really unfortunate because I think they were a tremendous boon for the industry because they allowed a seamless process for crypto companies and venture funds to actually start exploring this space. So it's sad to see them go down. But to sort of compound things, shortly after SVB, they had also said that they were having issues um, with their banking, but that's more holistic, not necessarily crypto specific. Um, so they reported that they sold, I think it was $21 billion worth of its securities for about $2 billion loss to shore up some assets on its balance sheet. Began raising capital from a number of other venture firms because they do a lot of work with VCs. So they provide a lot of funding for VCs and they do a great job. But unfortunately, that didn't quell a lot of the concerns Wall Street had about it. The stock fell by about 60% yesterday, which is pretty crazy. And then I believe it went down more than 20% after hours. So yeah, even though the SVB thing isn't necessarily crypto specific, there are a lot of people that use SVB for crypto banking. It sort of runs with the theme of regulators really cracking down on banks that deal in crypto, which is very unfortunate because there's a lot of people out there, a lot of banks that really want to comply, and there are people that have tried to build businesses that are actively looking for regulation and ways to comply, but they're not doing that. And I think I had mentioned the phrase Operation Choke Point, which hasn't been confirmed to be an actual thing, but they're targeting the banking system to eliminate a lot of people's ability to transact within crypto.
Okay, hold on a sec. So the SVB part, that's not related to crypto. That's ripple effect of the economy.
Yeah.
A run in the bank happened. A lot of VC investors sent out a message to their portfolio companies saying, hey, go down to your FDIC coverage limits, which is $250K.
Right.
That further screwed up their balance sheet.
Yeah.
But the crypto side of the story, what was the trade the bank had made that got them in trouble? Like, what were they doing?
SVB or Silvergate?
No, Silvergate. Like, how do they lose the $1 billion? Because it seems to me, you take in the money, you assign an interest rate, that's your cost, right? It's a chunk of your cost. Yeah. And then you go loan the money. Were they making loans into the crypto world? Because that seems risky. Or were they merely holding cash assets for crypto-related companies? Or did the actual the loss, have nothing to do with crypto itself?
Yeah, obviously it never helps that the crypto industry was down in general, in terms of the amount of deposits they had on hand. But the real issue is they held, in their treasury, they held long-term U.S. treasuries. And obviously with the big rise in interest rates and the convexity with the relationship between interest rates and bond prices, they had a pretty large loss on their U.S. Treasury positions. So ultimately, it just had to do with the Federal Reserve, and you can make the case that they shouldn't have been in long-term bonds because of for that reason. But nevertheless, it was more of an economic issue, in my opinion, than it was necessarily a crypto issue. I don't know if people know the story about Silvergate, but they started as a really small bank out in California. And when they heard about crypto, they sort of did away with the rest of their business and went all in on crypto. So, they without any regulatory clarity or anything like that, they just went, head first into the space. And, they had done a good job and arguably could have managed their balance sheet a lot better. But that being said, it's unfortunate that they fell, and banking for crypto services is it's hard to come by nowadays.
Okay, so it's a crypto bank, but the reason it fell is because they made the wrong trade on U.S. interest rates with the cash.
More or less, yeah, more or less, yeah.
They were betting on interest rates staying low, and they went up.
Yeah,
right?
and Yeah, it's typically not that big of a deal.
It's not how it's getting marketed. It's getting marketed as crypto folding, another crypto disaster.
Yeah, no, it doesn't have anything to do with really crypto. I mean, it's related to crypto to the extent that, if it wasn't such a bear market, arguably they would have had more business, and you wouldn't have been able to see the exposure on the treasury side. But yeah, I mean, the way you hear politicians talking about it would make it seem like, not only is crypto reckless, but the people that quote are trying to be compliant with us are also reckless. That I don't believe is the case. That's just some showmanship by politicians, pushing their books. So and a lot of these banks, even though they hold longer term treasuries, there was a bit of a run at Silvergate, but a lot of these banks hold the treasuries to maturity. So these are all mark-to-market losses. There very well may be another bank that has a similar balance sheet, but didn't get negative publicity for one reason or another, and they're still up and running. And we may never know if this type of a situation, if it were to happen to them, that they would also fold. So, it's partly a confidence issue that, unfortunately, politicians and people that are against crypto push this irresponsible narrative against Silvergate, which caused a run, and then sort of exposed this riskier, you could say, part of their portfolio. But I wouldn't say it's tremendously different from what a lot of banks are doing. It's just you don't necessarily either.
But the risky part of the portfolio is U.S. Treasuries.
Yeah, so they
That's
had a lot
hilarious. That's not the narrative. Okay.
They had a lot of interest rate risk. So,
yeah, it's interesting how delicate the psychology is for commercial banking, right? If people are scared that the money's not going to be there, you have no money, everyone withdraws, and you're hosed. And that's what happened to both these banks in 1 week.
Yeah.
So it's a bizarre moment and a bizarre business in that regard.
Yeah, and Silvergate had a network that connected all of the crypto exchanges and made it a lot more efficient. So that's going to be gone. So yeah, again, it's pretty sad to see Silvergate go down. And again, even though SVB isn't crypto specific, they are certainly embracing crypto. So unfortunately, they get tied into the negative connotations of being associated with the space. So. But otherwise, they're just a broader venture exposed company.
Thank you, Brett. Appreciate the update.
Thank you, Mark.
All right, so this has been a big conversation about all the things changing and what it all means. We've stayed pretty macro, high level in how we're thinking about this. I just want to give a quick shout out. There's a lot of people who lost a lot of sleep over the last week. Founders, teams, not knowing what's going to happen with payroll and their jobs and their companies and their life's work. There's a ton of people at these banks that have collapsed, that have just found themselves in a really tough situation. So just know, we're thinking of you. We're out here. If anyone needs help, definitely reach out to Interplay. You can find us at our website, interplay.vc, or get me on Twitter @MPD. But we're here to support.